Hey guys, I hate to interrupt, but I just wanted to take a moment to say if you're studying for the CPA exams and you like the visual learning approach that we take in this video, definitely check out Universal CPA Review's free trial. You can do this by going to www.universalcpareview.com, or you can click on the link in the description of this video. From there, you could take a sneak peek at Universal's platform, which includes animated video lectures, study guides, and practice questions with task-based simulations that come with video explanations that walk you through the solution step by step, kind of like having a tutor by your side. Okay, enough of that. Let's get back to it. Okay, so the fourth and final depreciation method that we're going to talk about is the units of production method. If you use it, you lose it, right? That's what they say, something like that. All right, so where this method is different is that it's the only one of our four depreciation methods that will not estimate the useful life of the asset for calculating the annual depreciation expense. So we are not focused on the estimated useful life of the asset, right? We don't care how long the asset will live per se. Instead, what we need to estimate is how many units we think we can produce from using this asset, right? What's our output? Okay, so as the name suggests, units of production is what we are focused on here. So as far as our four depreciation methods go, this is only a two-step calculation. All right, so other than the straight line method, this probably has the least amount of information that you need to keep in mind. So step one is determining the rates per unit or rates per hour, right? Depending on how we are measuring our units of production. So once we have determined our rate per unit or rate per hour, we can now apply this to the depreciation expense calculation. Okay, so let's go through a quick example. On January 1st, year one, Speedy Manufacturing purchased machinery for $30,000. The machine has a 5-year estimated useful life and a salvage value of $5,000. Okay, so with the new machinery, Speedy Manufacturing expects to manufacture 5,000 units over the life of the machine. But during year one, Speedy Manufacturing manufactured 900 units. Okay, so again, throughout the life of the machine, they expect to manufacture 5,000. This year, they only manufacture 900. So, assuming we are applying the units of production method for depreciation, what is the year one depreciation expense? So step one is going to be determining our rate per unit. So we're taking the original cost of $30,000 and we are reducing it by the salvage value. So the salvage value is $5,000. So this gives us this depreciable base of $25,000. Okay, so that is going to now be divided by the estimated units. Okay, so again, this is going to be divided by the estimated units, not the estimated useful life. This is all based on output. So we think that this machine will produce up to 5,000 units. Okay, so that's going to give us this rate per unit. We can now apply this to step two. So what is the total amount of units actually produced in year one? We estimated 5,000 units was going to get produced, but we only actually manufactured 900 units. Okay, so this is the amount that is multiplied by this rate per unit. And that's how we calculate our depreciation expense for year one. Let's take a quick break and catch our breath. Woo. If you like what you see in this video, well, you're not alone. Okay, many students who studied with Universal CPA Review have found a ton of success. And if you don't believe me, you could take a look at our reviews on Trustpilot. Trustpilot is the most legitimate third-party review site that ensures that our reviews are completely legitimate. Universal CPA Review is not only the best CPA exam study option for visual learners, but it's also the most cost-effective option out there. So if you've already spent thousands of dollars on another CPA review course, we totally understand, and we want to help you out. So take a look at our free 7-day trial and see if Universal CPA Review is for you. You can start your free trial by going to www.universalcpareview.com, or you could take a look at the link in the description of this video. Okay, so we are done with depreciation, but now let's talk about this thing called depletion. Conceptually, this is the exact same thing as calculating depreciation. The only key difference here is we're not going to be applying this to fixed assets. So instead of fixed assets, we're going to apply this to the cost of natural resources. So things like oils, minerals, gas. Okay, so believe it or not, these are assets to a company, right? If a big oil company is extracting oil, that essentially becomes their commodity. And like fixed assets, commodities can also spoil or waste away. Okay, so the idea here is that we extract these natural resources and they begin to slowly waste away in the same way that machinery or equipment will become outdated and eventually depreciate. So again, we're going to map this out, and we have 3 steps to our depletion mental map. So step 1 is going to be determining our depletion base. So this is the depletion cost that we're spreading out over the life of the asset. Right, so similar to the depreciable base that we always needed to determine for our fixed assets, only now when determining our depletion base, it's going to include more than just the original cost or that carrying value, less any salvage value. Okay, so there are more factors that go into making this asset's value. So the first cost that is going to go into the depletion base is going to be the acquisition cost, right? This is the price to actually obtain the natural resource. If we are fracking this oil, this could be the price for, say, leasing out this space. Okay, so anything that has to do with purchasing or obtaining the land to actually extract or obtain that natural resource. It's also going to include any additional development cost to prepare the land for extraction, right, as well as any estimated restoration costs. Now keep in mind, the depletion base is going to be reduced by the residual value of the land. This is more or less the equivalent to the salvage value. Only the salvage value can be the ability to sell off any additional materials related to a fixed asset. Only when we're thinking about depletion, we're thinking about land. Okay, so this could be the value of the land that we could sell off after we have completed our extraction. So after we have determined our depletion base, we can now determine our unit depletion rate. Okay, so this could be total amount of units per ton, could be units per gallon, could be units per ounces, right? Depending on what it is that we are extracting, right, and how we want to measure it. So this depletion rate is going to take the depletion base that we determined in step 1, and we're going to divide it by the estimated total recoverable units. Okay, so again, this gives us our depletion rate. Okay, so now we can determine our total depletion cost for a given year. And this is not going to be based on the estimated useful life. It's not going to be based on units of production. It is based on the number of units that have been extracted, right? We're extracting natural resources. So we're going to take that depletion rate that we determined in step 2, and we're going to multiply it by the total number of units that have been extracted. And that gives us our total depletion. Okay, so let's dive into a quick example and apply this mental map. Drilling & Co. purchased a piece of land for $1 million for the extraction of oil. The additional cost of $200,000 was incurred to prepare the land for extraction. Drilling & Co. estimated that it would be able to extract 600,000 gallons of oil throughout its useful life. At the end of its useful life, Drilling & Co. intends to sell the land for $40,000. So in the current year, 120,000 gallons of oil were extracted and sold. We want to know the amount of depletion that Drilling & Co. would record in the current year. Okay, boom. Step 1, we can determine our depletion base. Our depletion base is going to take the acquisition cost of $1 million. We're going to add the additional cost of $200,000 to prepare the land for extraction, and we're going to reduce this by the residual value of the land, right? AKA how much we could sell it for. So we could sell it for $40,000. Okay, so our depletion base is 1 million plus 200,000 minus 40,000. Okay, so we got $1,160,000 as our depletion base. We can now apply this to step 2 in determining our depletion unit rate. So we can take our depletion base of $1,160,000 and divide it by the estimated recoverable units. So we're going to divide this $1,160,000 by 600,000. Okay, so that gives us $1.93 per gallon. Okay, so how much did we actually extract for the current year? So Drilling & Co. extracted 120,000 gallons in the current year. So 120,000 will be multiplied by the 1.93 per gallon. Okay, so assuming that we're rounding, the depletion cost in the current year would be $232,000. Okay, people, so that's how it's done. We need to remember our different methods for depreciation. We need to remember depletion. Let's go through our mental maps and put together a systematic, structured approach. Okay, so if we know these calculations and each of these steps, this is going to be very easy points on the exam.